Good morning. For those of you that know what Mark Schmerschel sounds like, obviously it is not Mark today. I am Judy Coleman, and I will be presenting on his behalf. Maybe we can all agree that I look better in heels. We would like to thank ECFC for their continued efforts in advancing healthcare consumerism. As many of you may know, Mark Schmerschel, Vice President of BeneFLEX, is on the Board of Directors of ECFC. Mark and other ECFC members will be lobbying in Washington, D.C. in the next week or so. Any questions that we're not able to answer today, he will take with him and ask the relative agencies. For today's presentation, you will be in listen-only mode. If you have any questions, please type them in and we will get to them at the end of the presentation as time permits. We want to welcome all of our brokers and clients on the call today. As a reminder, the presentation today is about a new benefit for small employers with under 50 employees. If you are an applicable large employer with more than 50 full-time or full-time equivalent employees, this benefit would not be available to your company. We are going to be talking about a new arrangement called the Qualified Small Employer Health Reimbursement Arrangement, which was part of the 21st Century Cures Act. It was passed at the end of last year. This presentation has been approved for 1 hour of general CE credit for Missouri, Kansas, and Illinois. If you have not completed the form to request CE credit, this can be accessed in the navigation panel on the GoToWebinar panel under Handouts. Please download the PDF and click on the live link to complete the form. This information is required for us to submit for CE credit on your behalf. The course objective today is to educate our attendees on the history, benefits, and guidelines relating to the Qualified Small Employer Health Reimbursement Arrangement, Section 18001 of the 21st Century Cures Act. And then we hope that the benefit to you will be that it's to help insurance brokers and HR administrators develop a clear understanding of the guidelines for the new QSEHRA and how this new tax advantage program could be a potential benefit to your organization. Our agenda for today is to review the Qualified Small Employer HRA regulations. The new law allows qualified small employers to reimburse individual health insurance premiums and Section 213D expenses pre-tax under a health reimbursement arrangement. We want to discuss how the Qualified Small Employer HRA compares with other options. We're going to compare the Qualified Small Employer HRA to the one-person HRA and standalone HRA and to other pre-tax options. We hope you learn how to take advantage of the Qualified Small Employer HRA. We're going to review frequently asked questions for the Qualified Small Employer HRA. And throughout the presentation, you will also hear about additional guidance that we are requesting from the IRS and Treasury to clarify regarding this legislation. I think that we should first take a step back and talk about the landscape of healthcare and why we needed to have this new legislation. If you recall, small employers were not able to reimburse employees for premiums for individual health insurance purchased by the employees under IRS Notice 2015-17. What's the reason for this? Well, since the enactment of the ACA, the government has questioned how defined contribution plans fit under ACA's provisions. Specifically, ACA market reforms such as no annual or lifetime limits and first dollar coverage on preventative services. The IRS said that the employer HRA plans where the employer just reimbursed for health insurance premiums up to a certain dollar amount would violate these ACA market reforms, and the penalty for violation of those market reforms was $100 per day per employee. A penalty that applies even if the employer is not subject to ACA employer mandates. So small employers that were providing an HRA to reimburse premiums learned that they had to stop, and they said, wait a minute, we're not subject to the employer mandates, we're just trying to be helpful to our employees and the IRS and Treasury is telling us that we can't do it. There was some transition relief that ended July 1st, 2015. Small employers were very upset about this, so they really pushed through this legislation to allow small employers the ability to reimburse premiums. At the end of last year, during the lame duck session, they passed what is known as the 21st Century Cures Act. You probably heard a lot about the 21st Century Cures Act because it was a major piece of legislation. It was over 800 pages. Some of the big items that they were trying to deal with in this legislation were funding to fight the opiate epidemic, changing some of the FDA drug approval, and funding for medical research on cancer. Those were the major pieces that were in this legislation. And then there were about 15 pages dealing with the Qualified Small Employer Health Reimbursement Arrangement. And if you read any of the major news stories, they never really talked about this at all. This was 15 pages really based off of earlier bipartisan legislation sponsored in the House by Representatives Bustani and Thompson and in the Senate by Grassley and Heitkamp. But to us, this major bill, those 15 pages, will have a major impact for small employers. Why would an employer want to offer the Qualified Small Employer HRA? Well, it'll give employers a competitive edge in the marketplace to attract and retain talented employees. It gives employers the ability to offer an employee benefit without the overhead of a group medical plan. Employees may purchase any individual policy that will fit their needs. HRA reimbursements are tax-free to the employer and employee. Employers receive the same tax write-off for the HRA as paying medical premiums. For a C corporation, the average is about 34%, and for an S corp or LLC, it's the owner's tax bracket, so that would be at least 34%, if not better in some circumstances. Employees will receive a 25 to 30% benefit. Employer and employees enjoy cost savings in a difficult healthcare environment, and expenses are only paid if the expense is incurred by the employee. If no expenses are incurred, the funds will remain in the employer's account. So is the QSEHRA right for you or your client? Throughout this presentation, we're going to discuss the regulations and the benefits of the QSEHRA. I challenge you to think of your own clients in recent conversations to determine who may benefit most from this exciting new service. Here are some of the questions to ask yourself as we go through the presentation. Do you have under 50 full-time or full-time equivalent employees? Do you have a group health insurance plan in place? Are you looking for a benefit option to attract and retain employees? Do you want to offer your employees a tax-free reimbursement for individual or family health insurance premiums? Do you want to offer employees a tax-free reimbursement for Section 213D medical expenses? Do you want to offer an employee benefit without the overhead of a group medical plan? Are you interested in offering an employee benefit with a promise to pay for qualified expenses, and any unused funds will remain in the employer's account? The trends that we are seeing so far is this probably relates more to companies with under 25 employees, or companies that do not currently offer group health insurance because they either have a lack of participation in the plan, they have high turnover, the upfront cost associated with a group health plan, maybe they drop the coverage due to the high renewal premiums. Employers who want to offer a benefit to their employees, but they do not want to overextend their spending. So what is a Qualified Small Employer Health Reimbursement Arrangement that was established under this legislation? Let me go through the major points here, and then we will dig down further into each of the points in the requirements. The Qualified Small employer health reimbursement arrangements. And by the way, this is a terrible name for something you can't even do an acronym that falls easily off the tongue. Back in the day, Doris Day would have said QSEHRA, but some of you may be too young to have heard that. In our office, we say QSEHRA. That's kind of the acronym we've come up with. Some good marketer will come up with a much better name, I'm sure. But this is a defined contribution health plan that is sponsored by an employer that is not an applicable large employer, subject to the employer mandate under the ACA. The sponsoring employer cannot offer a group health plan to any of its employees. The plan must be funded solely through employer contributions. No employee contributions are allowed. Reimbursements can only be made to employees who provide proof of coverage with minimum essential coverage. And that's a big deal, which we will address later in this presentation. Employers may also allow reimbursements for qualified medical expenses under Section 213D, like any other health reimbursement arrangements. The maximum reimbursement for this qualified small health reimbursement arrangement is $4,950 for individual and $10,000 for family coverage. Reimbursements must be offered on the same terms to all employees. What's the benefit for offering a qualified small employer health reimbursement arrangement? This bill amends the Internal Revenue Code, HRA, and Public Health Service Act. It says these sorts of plans are not considered group health plans. What that means is, particularly with regard to the Internal Revenue Code, these types of plans will not be subject to the ACA insurance market reforms. Small employers can offer a QSEHRA and not be subject to the $100 per day penalty. If not offering a QSEHRA, that arrangement would be subject to the old rules where we talked about if you had a problem in meeting the market reforms. The other benefit you have under the QSEHRA is that these are exempt from the coverage rules of COBRA. Remember, a traditional HRA, which is covered by Tax Code Section 105, is covered by the rules of COBRA since a traditional HRA is considered a group health plan. Let's start going through the details of what is a QSEHRA. In order to establish one of these, you must be an eligible employer. Eligible employer must not be an applicable large employer for purpose of the employer mandate under the Affordable Care Act. Well, what does that mean? That means you must employ less than 50 full-time or full-time equivalent employees. One of the questions that we ask about this is what happens if you become a large employer during the year? What does that mean? That is a question that we're going to ask the relative agencies. And as a side note, ECFC is putting together questions where they're going to go to the IRS and other agencies to ask for answers on a number of unanswered questions that have come up in reviewing this legislation. So as we go through this presentation, I'm going to raise some of those points and questions that we haven't really heard. And again, we will have questions and answers at the end of this talk. If I can't answer your questions, we will add them to our list of questions that we're going to ask the relative agencies. So in order to be an eligible employer, you must have less than 50 employees, and you must not offer a group health plan to any of your employees. There is a question here as to what it means by offering a group health plan to any other employees. One question is, are dental and vision coverage counted as being a group health plan, which would not allow this employer the ability to offer QSEHRA? We don't think so because normally dental and vision are considered accepted benefits, but I think the language in this bill is not clear and official guidance would be helpful. The other thing to remember when we are determining who is an eligible employer is the controlled group rules do apply. So you're going to have to look at all of the entities within the control group for tax purposes. You wouldn't be able to divide up a large business into a group of smaller businesses and say we are going to offer this to one or more of the smaller businesses. Yet you're going to have to look at all of the businesses in the control group to determine whether you are an eligible employer for purposes to see if you are large and whether you offer a group health plan to any of your employees. In these control group rules, the IRS has been looking at and determining whether they are subject to the employer mandate under the ACA. The next thing we look at, the requirement that the QSEHRA is funded solely by employer contributions. So you're not going to have any sort of employee contributions used to fund these HRAs. So this is not going to be like an FSA where an employee chooses whether they want to participate and reduce their salary. This is similar to a traditional HRA where employee contributions cannot be made. The next requirement is the plan must be offered on the same terms to all eligible employees. All eligible employees are offered the same reimbursement as all other eligible employees. They say you can have differences in the amounts reimbursed if the difference is based off of the price of insurance in the relevant health insurance market. This is based on age of eligible employee and family members and number of family members covered. I think there is going to be some guidance needed as to how to document such differences because they are based off of the price of insurance. Many times what you will see with the HRA is you will have $1 amount for single coverage and maybe you double that amount for family coverage. Well, in this case, the doubling would not match up to the price of insurance, so you may not be able to do it that way. I think there will be a lot of questions about how to determine a different dollar amount available for this HRA. Again, all controlled group rules apply in this test. Now, I use the term eligible employee for making this determination. There are a number of employees that are disregarded in determining who is eligible. Employees who have not completed 90 days of service, employees who have not attained age 25, part-time or seasonal employees, employees covered by a collective bargaining agreement, non-resident aliens who receive no U.S. source income. These are the employees that are disregarded in terms of whether they are offered coverage under a QSEHRA. The employer need not offer reimbursement for these disregarded employees. You would go back to the guidance dealing with the Affordable Care Act to determine who is part-time and who is a seasonal employee. When we look at the reimbursements that are being made under the QSEHRA, what are the restrictions? The first one is reimbursements can only be made for qualified medical expenses under Section 213D for employees and family members. We generally know what a qualified medical expenses are under Section 213D, and this would include health insurance premiums, unreimbursed medical expenses, premiums for dental, vision, Medicare, and Medicare supplement coverage. Again, one of the things that you need to remember is that Medicare secondary payer reporting requirements apply if you're providing reimbursements for such coverage. The next restriction is something new. Reimbursements can only be made from a QSEHRA to those employees who provide proof of coverage. Now, there is no definition given for proof of coverage in this bill. So what we need to do is we need to get guidance as to what is proof of coverage. What I think they're trying to get at is they want people to only get reimbursed if at the end of the day they are covered by some sort of qualified health insurance. I would think if the QSEHRA was reimbursing for premiums for health insurance on the individual market, just the fact that they are asking for that reimbursement for premium payment would probably be proof of coverage. I think where we run into issues is if we're reimbursing for the employee and members of the employee's family for qualified medical expenses. The employee would have to provide proof of coverage due to being enrolled in the health plan provided by his or her spouse through the spouse's employer. As long as the plan allows, the employee could be reimbursed for any qualified medical expenses of the employee and his or her family that were paid for on an after-tax basis and not paid for through the health plan of the spouse's employer. Could the arrangement reimburse the employee for the spouse's contributions for coverage under the spouse's employer plan? We think generally not, where the spouse's coverage is funded on a pre-tax basis. But there may be limited circumstances where the reimbursement of such contributions could occur where the spouse's coverage is funded on an after-tax basis, such as for retiree medical coverage contributions. We need to know the employee has coverage under some sort of health insurance, and that might be a little difficult for an administrator to do unless the administrator is also providing reimbursements for health insurance premiums. I think this is one of the interesting issues that are going to be coming up for QSEHRA, is what happens if you're not reimbursing for other insurance premiums? How do you determine if the individual has proof of coverage? The other restriction on reimbursements is a maximum reimbursement amount of $4,950 for individual coverage and $10,000 for family coverage. They will be indexing for inflation, and I think we have to have more guidance if the HRA is established in the middle of the year. Does the amount need to be prorated? What is the maximum reimbursement then? When we establish an HSA in the middle of the year, you can make an HSA contribution for the full annual amount, but that is a statutory availability. We're going to have to see what they say with regards to the maximum restrictions for the QSEHRA. As we are talking about reimbursements, I think one of the other interesting things is the tax treatment of reimbursements from a QSEHRA. This is a new requirement, and this requirement was not in the previous legislative proposals, the Bastani proposal or the Grassley proposal that I mentioned earlier. Generally, reimbursements from any HRA would be excluded from the income of employees because they would be reimbursing you for qualified medical expenses under Section 213D. But there is an additional requirement that is added to reimbursements from a QSEHRA. The employee must have minimum essential health coverage during the month in which the qualified medical expense is incurred. So for example, let's say that the employee asked for a reimbursement in October for a medical expense that was incurred in March. Well, what you are going to have to do is, in addition to determining if a qualified medical expense is Section 213D, you're also going to have to look to determine if the employee had minimum essential health coverage in March. This may be easy to do if the reimbursement of health premiums are done in addition to other qualified medical expenses. If the employee is being reimbursed for that month's premiums, well, yes, that month I know the employee has minimum health coverage and therefore met that requirement. So if the employee doesn't have minimum essential health coverage at the time the expense was incurred, then that reimbursement is going to be taxable to the employee. Another issue that comes up with the QSEHRA is it specifically addressed what the impact on the QSEHRA would have on the subsidy available for low-income individuals who purchase insurance on a state or federally facilitated exchange. Remember that an individual may get subsidized coverage depending on what their income is and if they are receiving affordable coverage from his or her employer. So the question that is addressed in this legislation is coverage provided through a QSEHRA considered to be affordable coverage, which would eliminate an employee from receiving the premium tax subsidy. The bill says coverage would be considered affordable if 1/12 of the employer's contribution for a year is not less than the monthly premium for self-only second lowest cost silver plan, and the employee's cost of coverage for the individual market coverage does not exceed 1/12 of 9.5% of the employee's household income. Therefore, a generous reimbursement under the QSEHRA by the employer will likely mean that the employee is not eligible for a subsidy for insurance purchased under the exchange, whereas a more limited reimbursement may not impact the employee's eligibility for a subsidy. Since only employers that are not subject to the employer mandate are eligible to establish a QSEHRA, the fact that some employees will receive subsidized coverage through an exchange will not cause the employer to become subject to an ACA employer mandate. Now, I tried to work through some examples. Here you will see I have two examples of when doing a QSEHRA would have an impact on employees. If you would look at the example in this slide, the first example, I used a household income of $40,000. The employer contribution to the QSEHRA is $4,800. I looked at what the second lowest cost silver plan was, and it was $650. And then let's say I'm reimbursed $400 per month for health insurance. When I went through the requirements of the coverage, and the 1/12 of the HRA contributions was $400, well, that's less than $650 monthly premium for the silver plan. So that means I did not meet that requirement. The cost of coverage does not exceed the 1/12 of 9.5% of household income. The coverage was not affordable. And then I did a second example with a larger household income of $100,000. And even there, the cost of coverage made it not affordable. This is due to the fact that the maximum contribution of $400 was less than the monthly premium of the silver plan. I have a feeling when they put together this requirement, they really didn't think through what was the impact of putting the dollar caps on how much you can run through this plan. The next thing that comes up with QSEHRA that are new are the reporting requirements. First, the employer will have to report the amount of the employer's contribution to the QSEHRA on the employee's W-2, and it will probably be a separate code. Employers must also provide an annual notice to the employees. The notice must state the amount of the benefit provided to the employee under the QSEHRA. It must inform the employee that they should provide this information to any health insurance exchange if they are purchasing subsidized health coverage. The notice should explain the tax consequences of reimbursements if the employee fails to maintain minimum essential coverage during the year. If the employer does not do the notice, there's a penalty of $50 per day and up to $2,500 with reasonable cause exception. I think what we will need to do is ask the IRS to provide a model notice and guidance, because really the only thing that changes from employer to employer is the amount of the benefit that is being provided to the employees. So an HRA model notice would be very helpful. One other thing, while we are talking about these arrangements, we should be concerned about some state laws. There are some state insurance codes which effectively prohibit or limit employer funding and involvement with major medical coverage provided through individual policies by treating such coverage as being subject to the state small group rules. For example, Oregon law makes an individual coverage subject to small group rules if the coverage is employer funded. We think that such rules should be preempted by ERISA, but every time that you look at ERISA preemption, it's never a slam dunk that state laws are preempted. I think that one of the things that you should be concerned to see if there are any state law issues if you're setting up a QSEHRA. Now let's talk about the effective date of this provision. This provision is effective for plan years beginning after 12/31/2016. Our phone has been ringing off the hook with interested employers and brokers. Employers are offering the QSEHRA on or after January 1st, 2017 must provide notices to their employees by March 12, 2017 for 2017 arrangements, and at least 90 days prior to either the start date of the plan year or the employee's initial eligibility date going forward. The agencies issued some helpful FAQs on this provision on December 20th, 2016. The FAQs helped with the transitional relief, and the legislation provided that the transitional relief for small employers that provided for these arrangements wouldn't be penalized for violating the insurance market reform rules. They made it clear that the transitional relief applies with any plan year before 12/31/2016. If you have any people who already have this arrangement in place, they will not be subjected to any penalties for it. The FAQ also said that employers have arrangements that do not qualify as a QSEHRA will not be grandfathered. So is the QSEHRA right for you and your clients? Again, do you have under 50 full-time or 50 full-time equivalent employees? Do you have any group health insurance plans in place? Are you looking for a benefit option to attract and retain employees? Do you want to offer your employees a tax-free reimbursement for individual or family health insurance premiums? Do you want to offer your employees a tax-free reimbursement for Section 213D medical expenses? Do you want to offer an employee benefit without the overhead of a group medical plan? If you're interested in offering an employee benefit with a promise to pay for qualified expenses, any unused amounts will remain in the employer's account. So here we've given you an example of how an employer could set up a QSEHRA. So this would be based on individual coverage. So the employer is giving the employee the full $4,950 annual contribution. So each month the employee would be eligible for $412.50 in reimbursement. Under the first example, the employee went out and purchased individual health insurance, and the premiums were $300. So that employee could be reimbursed up to $300 for their monthly health insurance premium, and then they would have $112.50 remaining for Section 213D expenses. In the second example, the employee purchased a plan that cost $350. So that would allow him to be reimbursed up to $62.50 for Section 213D expenses. And in the third example, the employee went out and purchased a $375 plan, so they had $37.50 remaining in their account to be reimbursed for Section 213D expenses. In all of these examples where the employee receives the full $4,950 in their QSEHRA, they would have an annual tax savings of approximately $1,485, and on a monthly basis, a tax savings of $123.75. So as you can see, this type of plan could be very beneficial for your employees. One other thing before we end and start opening up for questions. The reason we have this bill is to help small employers that were helping their employees by reimbursing them for premiums for individual coverage. They were stopped from doing that because of the market reform requirements under the ACA. We all know one of the first things Congress is going to try to do is to repeal the Affordable Care Act. And in general terms, that means the ACA market reforms will be eliminated. The first thing I would be concerned there is to talk about repeal in the ACA and questions on that when that repeal would actually be effective. There also might be some market reforms that might somehow be reinstated. I think it's not going to be clear until we know how and when the ACA will be repealed. At that time, we will have to evaluate whether a QSEHRA would be a viable option or not. So that's our general overview of what's going on with the QSEHRA, and I think now we will turn it over to everyone to ask questions. So if you have any questions, you may type them in, and we will get to those. So the first question is are the contribution dollar amounts can they be based on the actual premium for each employee? And yes, the contribution may be based on reimbursing the employee for their actual premiums. Another question is, could the small employer HRA plan reimburse another employer group sponsor plan? So if you have a husband and wife and worked at an employer that offers a qualified health plan, and they have to pay a premium to be enrolled in that health plan, but the spouse works at an employer that has the small employer HRA, could that HRA then reimburse the employee's or her spouse's share in the employer health plan? That answer is not quite clear yet. The three requirements are met. They have health premiums, they have proof of coverage, and they have minimum essential coverage. So we think so, but we are looking for additional answers on that question. This does bring up like a second question, though, from the same employee, is can an employee with a QSEHRA pay premium of spouse if spouse pays insurance pre-tax through a POP plan? That answer would be no, because that would be considered double dipping since the premiums are already running through a POP plan. We have another question. Since these are considered health plans under the regulations, does this give the employer that is going to offer this opportunity the opportunity to offer a flexible spending account plan to those employees as well? Well, this is not considered a group health plan, so we don't think so, but we may need some additional guidance. If the employer was offering a QSEHRA, there is the possibility that they could still offer a limited purpose flexible spending account where it's limited to dental and vision because those are accepted benefits. And they could also still offer the dependent daycare flexible spending account. So the next person has a two-part question. The first question is, if a group is qualified to offer this plan, can they limit it to just paying premiums instead of paying premiums and 213D expenses? And yes, it is at the employer's discretion as to whether or not they're going to reimburse eligible Section 213 expenses. The second question is, if they limit it to just premiums and their employee goes out and purchases a qualified high-deductible health plan, can those employees then contribute to a health savings account and get some tax exemption that way? And yes, there would be no regulations against them opening a qualified a health savings account if they have a qualified health plan in place. So we'll give it just a few more minutes, but right now there are no other questions that are coming up. So the next question, if there are additional costs required by the employee for the premiums, there is no way for the employee to pay the additional premium pre-tax through the employer. That is correct. They would not be able to pay it through the employer through a POP plan. However, the employer, if the employer was maybe paying the premiums for a list bill, the employer could take the additional premiums on a post-tax basis. So you would combine the contributions from a QSEHRA and the post-tax amount from the employee so that they could pay the bill. And the next question is when do you expect full regulations to be finalized for these plans? And honestly, we don't really have an answer to that. ECFC is in the process of putting together their list of questions to send for final guidance. So it's hard to say how long it will take. We know that they're very busy working on, you know, the ACA repeal and replacement. So it's really hard to say how long we're going to have to wait for final guidance. Okay, I believe that is all the questions that we have today. So we want to thank you for taking the time to listen to our presentation. We will be sending out the presentation, the slides to everyone that was registered for today's presentation. And if you have any additional questions, please do not hesitate to contact us. And once again, we thank you for your business. Have a great day.